Hi, everyone, and welcome to another YCharts webinar. I'm Connor Kitko, and I'm joined today by my colleague, Joe Kleben. How are you doing today, Joe?
Hey, Connor, doing well. Great to be with you and can't wait to discuss all the big events that happened here in Q3 with you.
Exactly, and more to come here between now and the end of the year for sure. That we do know. Lots uncertain, but as we do every quarter, today we're reviewing the most recent economic update deck from YCharts. We include visuals and data summarizing every quarter and here, Q3 of 2022. And our hope is that all of you out there can use this data to navigate whatever the market and whatever the economy has in store for us. Quick disclaimer, none of this data and information is investment advice. It's just informational purposes, educational, and YCharts is not acting as an advising party regarding client funds. If you are a client of YCharts, you're a user, you can access this full deck just by logging into your account. And I'll show you how to do that in a moment. It's just under our support topics and then resources menu. Even if you aren't a YCharts user yet, you can download a free shortened version of this deck. It doesn't have a lot of the commentary, doesn't have all the slides, but you still get a lot of good stuff. The easiest place to get that is to go to our blog. If you go to YCharts.com and then open up the blog, there's a very recent post in there, Economic Update Q3, and you can download that free copy of the shortened deck. One or two more housekeeping items before we jump in. Number one, nearly all of this data that we're reviewing was published by different government agencies in mid-October. And so the data is fresh as of last week or the week before, and all or most of the data is as of Q3 close, which is September 30th. So that's the as of date for everything unless otherwise noted. We will also be emailing a recording of the session to everyone who's attending. So if you need to jump early, whatever it may be, we will be sending that recording out to your inboxes. If you want it even sooner, we're pretty good about uploading these recordings in just a couple hours. So head over to the YCharts YouTube channel, subscribe to us there, and you'll get a ding as soon as we upload that video this afternoon. Okay, now I'll pass it off to Joe to get us started with the reason we're all here, to talk about some econ data.
Yes, indeed. Thanks, Connor. So let's indeed kick things off with some charts that are showing performance of major market indexes from Q3. So as we all saw, US stocks continued their slide in Q3 after logging a red first two quarters of the year. And it was the Dow Jones Industrial Average that fell the furthest domestically with a 6.17% decline in the third quarter. And the worldwide equity picture was bleaker than that domestically, with the MSCI Emerging Markets Index tumbling 11.42%. And so now going to layer deeper into domestic performance into sectors. So over the course of Q2, we saw that not a single S&P sector posted a positive return. Now, Q3 had a little improvement, seeing 2 of the 11 S&P sectors posting a positive return during Q3, that being consumer discretionary up 3.8% and energy up 1.81%. The other 9 sectors, however, were all in the red in Q3, with communication services and real estate falling the furthest, down 11.57% and 11.07% respectively.
Awesome. Thank you, Joe. Interesting to see energy back in the top of the table there. We'll talk a little bit more about gas prices and everything a little later on, but certainly a driving force for the energy sector. Okay, now let's talk a little bit about asset class performance. And so this table shows us asset classes over different time frames, increasingly longer look backs going from left to right. We see that US small caps were the relative outperformer in Q3, although in the period they fell by 2.2%, and the asset class is still down more than 25% year to date. So that's looking at our leftmost column here, US small caps. Commodities are still leading year to date, up 21.8% through 3 quarters, and that comes even after posting a negative 10.3% return in Q3. hit hardest of all these asset classes recently are real estate, emerging markets, as we just saw in the MSCI index, US growth. And that said, US growth in Q3 was a relative break based on what we've seen over the last year for growth stocks. Let's jump into similar data, but we're going to look at this quarter over quarter. And then after we talk about this data, we're actually going to show you how to access a template for these asset performance quilts in YCharts. But we're going to look at this quarter over quarter, 15 quarters of history, and we see some patterns kind of crystallizing here a little bit more clearly. US small cap was the relative top performer in Q3, like we said, but its position on this table is very volatile quarter over quarter. So looking at these pink squares, you can see how it's bouncing all over the chart as we look into previous quarters. And we can also see the same thing for commodities. First negative quarter going all the way back to Q1 of 2020. Commodities here in the green. And wherever it was on the table, it was always positive since that negative 42% drop back in Q1 of 2020. Additionally, this is just the second negative quarter in the last 15 for the real estate asset class. And finally, we see that US stocks, the S&P 500, US stocks are having a hard time making it back into the top third of this table. US stocks in this lighter green bar, used to be, a staple in these top 3 or 4 positions, and now having a hard time over the last 2 quarters of this year. Okay, I'm going to show you this template real quick. So we're going to jump into YCharts, and I've hovered over Tools and then opened up Excel. The Excel add-in is for YCharts professional users only, but we have all these great templates in here. If you scroll down to this one, investment heat map, I'm going to show you the preview. It's very similar to what we were just looking at, where you can plug in some different securities, a group of different securities, and then have that quilt created for you with their performance period over period. Definitely a good one to take advantage of there. All right, Joe, back to you.
Yeah, indeed. So, and I certainly like the Excel add-in myself. I mean, use it for a lot of different templates, and definitely a crowd pleaser and would recommend. And so now as we move on here to performance of diversified portfolios. So this slide is pointing out various risk and return strategies, which is made possible by our model portfolios tool, where you can model strategies and pop them in just a matter of clicks. And so this here slide includes stock to bond allocations of 80-20, 50-50, 20-80, and a all stock S&P 500 total return portfolio. And it was the S&P 500 that fell further, now down 24.35% off of its all-time high on the first trading day of 2022. And the 20-80 allocation, with its conservative nature, is the relative outperformer over this previous year, down 14.41%. So not too much of a plummet as the 100-0 portfolio, but still definitely in the red, even with that bond allocation there. And again, this visual demonstrates the value that diversification can provide investors during these turbulent periods that we've seen in 2022 for both the stock and bond market when things are down.
Awesome. We're going to try one thing real quick with our presentation based on a question that came through. Hopefully that's a little larger and everyone can see here, but we're going to continue on to talk about the rest of our data here. Bonds and interest rates. So the third quarter of 2022 brought more action to the yield curve. Treasury rates continue to rise across the board, and by so much so in that short end of the curve, the near term, that we have even more inversions than we did when we talked about this chart last quarter. So this is as of the end of Q3, September 30th, but we do have to note that as of October 25th, the 10-year to 3-month spread has also inverted. So the 10-year to 2-year spread, that popular recession indicator, and the 10-year to 3-month popular for the same purposes, are now both inverted. Looking at our table on the left-hand side of all of these treasury rates and where they were as of given quarter ends, and then all these green arrows showing that they've been doing nothing but rising. But the 5-year treasury rate ended Q3 at 4.06%. That's greater than both the 10 years 3.83% yield and the 30 years 3.79%. You have to go back to November 2007, which was the last time the 5-year was above 4% yield. So what is that, 15 years? An inverted, flatter yield curve like we're seeing right now can indicate uncertainty about economic growth in the medium and the long term. We know that there's a couple more Fed meetings on the calendar through the rest of this year, so we're definitely watching to see what happens there.
Indeed so, and we've also seen some reports of negative GDP growth as well. So we will see what is on the horizon coming forth in economic data. But speaking of economic data, macroeconomic data. So we're going to show up here a heat map of various economic data points, which are considered leading indicators and show their trends over time here dating back to 2009. The first 3 columns show a quarter by quarter change throughout 2022, and those following 13 columns show annual changes in the data. We see that US index of consumer sentiment bounced off its lowest level in more than a decade, rising to 58.6 at the end of Q3, though still historically by its average rather down. And the 10-2 treasury yield spread, like Connor just mentioned, inverted shortly into Q3 and has remained inverted since, and ended the quarter at inverted by 39 basis points there, so quite deep in the red for that 10-2. Lastly, the Philly Fed Manufacturing Activity Index is I would say the standout here for Q3, which also dropped further below zero to negative 9.9 rather, a level last seen in early 2020 during the coronavirus pandemic onset. And with all these indicators that we have in YCharts, I think now would be a great opportunity just to hop into YCharts real quick and just show the data points here that we have and all of the insights they can provide. Here is an example of one of those, and this is US housing starts month over month, showing historical data, the chart right there, as well as the info of where it comes from, and a bunch of great key statistics. You can even toggle the time period on that chart right on the quote page to give you any time frame. And if you even go into view full chart, you'll actually be able to layer on, or interactive chart for that matter, you'll actually be able to layer on any other economic indicators, stocks, ETFs that we have in YCharts to illustrate your story the way you see it, communicate to clients and prospects, even just maybe friends and family, what's going on in the markets. And here we, as an example, add on US building permits and that month over month change as well to give us a better picture about what is going on truly in the housing market. And that's a great way to leverage fundamental charts for all of your illustrative and market commentary needs.
Awesome. And I'm going off script a little bit here, Joe, to just show those versus those month over month figures. We can look at the totals as well. So if that's how you prefer to, some people want to look at the month over month change in the context of a chart. Maybe this is a little bit more your speed, but we got the data both ways. So whichever way you want it.
Indeed, we do.
Awesome.
All right, so now we'll shift here next into US trade balance. So this slide here shows the trade activity between the USA and other key partners through Q2 of 2022, when data is latest available. The chart on the left shows that US imports have continued to climb and outpace US exports, and US imports are now at a level of over $1 trillion per quarter. US exports have also continued higher, but we do see that the chart on the right shows the divergence of trade imports versus exports, aka the trade balance, and we see that bouncing off of its lowest trade balance ever recorded, which was in Q1 of 2022. If we look at this table below the two charts, This shows us how imports have increased year over year in all regions. And at the end of Q2 of 2022, services imports from Canada and the European Union had the largest increase year over year at 47%. So definitely some high level and potentially outline activity there.
Interesting. Always interesting to see the trade balance, and especially, what's going on here. Are we in a new normal territory? Are we going to come back up to where we were? I guess we'll find out. Okay. Let's focus here. We're talking about housing market data, and we're going to focus on this upper left-hand chart first, which shows us the 30-year mortgage rate, the percent change in the number of mortgage originations, and then the share of those originations which are actually refinances by current homeowners. So at the start of 2021, we had the lowest 30-year mortgage rate in decades, and originations were up about 170%. So that's what we're seeing right here, Q4 of 2020. And that's relative to Q3 of 2018, back where this chart started. I'm getting very click happy on the slides today. I apologize. But at the start of 2021, that lowest mortgage rate, since then, mortgage rates have shot up to end Q3 at 6.7%, and they even moved above 7% in the time since. We have not seen levels for mortgage rates that high since 2002. And just about a third of new originations currently are refinances, so much lower percent of that mix now. Despite home prices having plateaued or coming down slightly, as evidenced by our Case-Shiller home price index in the table at the bottom here, the equation for the cost of home ownership includes two parts. It's the prices and the mortgage rates, and I guess property taxes too. But neither factor, mortgage rates or home prices, are really encouraging for prospective home buyers right now. Very high mortgage rates, and although prices aren't increasing anymore, still haven't really come down by much. In the upper right hand of our chart, you can see a lot of leading indicators or surveys for the housing market are actually down to below pre-COVID levels, and these have continued lower in a pattern very similar to what we've seen from equities, actually moving lower, a couple of reprieves, but overall throughout the course of the year, sentiment on the housing market has been decreasing. Okay, talking about some US dollar strength. Sure, you've been following everything that's happening with the US dollar versus the British pound versus the euro. Great time to take that European family vacation. But here we can visualize these currency pairs for a couple key international currencies. The US dollar to the euro, to the pound sterling, the Chinese yuan, and the Japanese yen has moved to 52-week highs in Q3 of 2022. The US dollar actually achieved parity with the euro for the first time since 2002. And the dollar also approached parity with the sterling pound in Q3, but quickly retraced from that level. And all of that despite what we've seen and heard, a lot of financial concern, worries about the financial plan of the UK, coming with a lot of turnover in their government as of late. And jumping up to this top chart at the top of our screen with the blue and green and red on it, we see that ICE US dollar index, which tracks the US dollar against a basket of international currencies, including those that you see on your screen. This ICE dollar index is steaming higher, even as CPI and consumer purchasing power look like they are plateauing relative to what we saw back earlier this year. Okay, now we're going to get into what we call our charts of the moment. These are some of the more topical and interesting storylines that we've seen in the market and economy. And I'm going to pass it to Joe for the first one there.
All right. Thanks, Connor. So kicking it off with one that is on a lot of people's minds these days is about valuation of the market, and are they back to the mean? So we see here that the S&P 500 CAPE ratio, stands for the cyclically adjusted PE ratio, hit a 20-year high towards the end of 2021, topping out at 38.58. But since then, a sharp decline has seen it regress towards its average over that time period. Now, this is in large part due to the market declines having taken place in 2022. But one other element to watch is the effect of Q3 earnings on the CAPE ratio, with the largest reports now in the rearview mirror, and notably some disappointing results from mega cap companies that sent their stocks plummeting double digits or maybe even more. This could send the CAPE ratio potentially even lower, given how much those companies comprise of the overall market. So it will be interesting to see the new calculation of the CAPE ratio in just a short time. And now on to our scatter plot showing the winners and losers of Q3 in the S&P 500 versus their year-to-date returns. So this scatter plot, it's showing the S&P 500 constituents in two segments. Those that had a positive, they're in the green, and those that had a negative in the red, a return in Q3 of 2022. This quarterly return is plotted against the year-to-date return, which is there on the y-axis. And although a third of all S&P companies had a positive third quarter, nearly 70% of those winners are still down year to date. So since there is a bit going on here with this scatter plot, and it is one of our newer tools on YCharts, let's hop into scatter plot real quick and quickly show how you can recreate this chart for your own purposes to share with clients, prospects, or just even with your team. So here we're starting off with the S&P 500 total return indicator on a scatter plot. Our current metrics, looking at the annualized standard deviation of monthly returns and a 5-year look back, that's our risk, and return at the same time frame. What we can do to recreate this chart is just type in those 3-month total returns. And then therefore, we can set this to 9/30/2022 to get that end of Q3 view. We can do the same date for there on the y-axis, and we'll change that guy to year-to-date total returns on a monthly basis. And lastly, what we'll do is we'll pull in, using the list feature, we'll pull in the S&P 500 index, which will then automatically import all 500 and change S&P 500 constituents into the scatter plot for here in a single view. And just a couple seconds, just like that, you've got yourself the scatter plot. If you do want to recreate the green versus red winners and losers of Q3, the easiest way to do that would just to be create your own watch lists and then just bring those in through the securities and lists tool like we just did there. And that way you'll be able to export to a PNG, an image file, that green versus red winners and losers makeup for S&P constituents.
Awesome. And I'm just playing around with colors at this point, but also showing off that you can, change up how these visuals look to tell the story that you want to tell. Awesome stuff. Love the scatter plot tool. Lots to play around with there. Okay. Moving on, talking about that oil and gas picture, like we mentioned earlier, WTI and Brent crude oil hit highs in early 2022. About $123 per barrel and $133 per barrel, respectively. However, we've seen this trend reverse throughout Q3, and each spot price has decreased by more than 25% of its relative peak. This has translated to a drop in retail gas prices. Hopefully, we've all been benefiting from that in our personal lives, down to $3.83 per gallon average across the US. But maybe you caught the rhetoric coming from the White House recently after a lot of strong earnings reports from energy companies. President Biden is, urging them and threatening with taxes for gas prices to go even lower. Who knows, given the timing with midterm elections just next week, if that will be acted on or followed up on, or just kind of another talking point. But certainly, still above average or above the recent average gas prices that we're all paying at the pump. Moving right along to inflation, and we'll look at the top panel of our chart first. You can see that inflation rates have not increased in the last few months, but year over year figures, inflation still very highly elevated, and we are nowhere near that target 2% rate from the Fed, obviously, but we'll wait to see about Fed rate hikes to see if this number comes down further. The inflation rate was 8.2% as of September's end, and core inflation actually logged a 10-year high of 6.63%. Since our core inflation number is all the same inputs except gas and food, this indicates to us that food and energy are still the biggest drivers of that inflation rate, because 8.2 is higher than 6.63. However, it's actually these other inputs that are pushing core inflation higher, things like vehicles, apparel, medical care, transportation. Those are what's causing this core inflation rate to set a 10-year high of 6.6%. Okay.
You have that Fed meeting today, which should be another historic one. So we know there's a lot of you on this webinar that are going to be anxious for that too, to see implications. So we'll take you home here with two last charts. And the first one we have is retail sales breakdown. And so this is showing US grocery store sales, US gasoline station sales, US clothing and accessories store sales, and sales in US furniture, home furnishing stores. These four segments of retail sales have all seen general increases since the onset of that coronavirus pandemic in early 2020. Gas station sales notably have soared, more than doubling in that time period, even as vehicle miles traveled was down about a year to 2 years ago. Now we see, with the increase of gas prices, probably contributing to that increase in gas station sales.
I'm just looking at some of these very interesting stuff, Joe, like this grocery store trend just becoming faster, probably on higher food costs, but then stuff like furniture and clothing, we're all just buying more of these things these days. More time at home, new outfits because of a COVID weight change, perhaps.
I don't think you're wrong in any of those facets too. And I think we also see that the difference between discretionary and non-discretionary spending, when we had certain sectors close and certain ones that, I remember when we were at the grocery store all getting frozen fruit at once. So definitely a boon in those grocery store sales. And so last but not least, the inflation adjusted earnings chart here. So on the top panel, we have wage growth, which is illustrated by the metric US average hourly earnings, which has for the most part consistently set all-time highs and has grown rather steadily. However, other inflation inputs have risen faster, which has resulted in real average hourly earnings now below those pre-COVID levels. In fact, this 10.95 figure is about the same as it was in June of 2019. So while those real earnings on your paycheck has risen over time, the real amount, which is rather adjusted for inflation, has not really made any significant strides in the last 3 years. So certainly an interesting point to watch, with inflation being on top of everyone's minds, and how maybe even the midterm elections will impact the status of that too.
Yeah, very interesting, very not the most positive chart, but hey, if you're going into a negotiation with your employer at the end of the year, maybe you bring this chart with you and just show them, what's really going on. We'll see if that works out for you. Report back if this chart helps in your salary negotiation. Okay, Gordon and Kurt, you guys both asked questions and we're happy to answer those now. And then we'll just kind of wrap things up. But Gordon asked, what tickers are used to generate the quarterly heat map? And so let me just go all the way back here. Assuming you're referring to this one, Gordon, you can see here for those different asset classes, the different indices that we are using to find those performance figures. And then hopefully that helps, but if not, follow up with us. We can point out what was behind any of these visuals for sure. And then Kurt, how do we make the US housing market data chart ourselves? So if I go to that housing market picture, let's start with this one up in the left, because this one has a couple different formats going on, I would suspect. So we're looking at 30-year mortgage rate, mortgage originations, and mortgage originations refinance share. So let's back out of here, and I'm going to go into our charting tool. And then I'll bring up the 30-year mortgage rate. Love the type to search on everything. We'll bring up mortgage originations, US mortgage originations, and then US mortgage refinancing share. And so this this is a good little on the fly lesson for YCharts, because you'll notice that we have this data format over here in original, but we're working with some mixed data. Some is already as a rate or as a percentage, and some or one is just a raw value. So what I'm going to do is actually change this chart to normalized. And we're not done yet because we don't like to look at percent changes of percent values. So what I'll actually do is click on the annotate tab. And then since I know 30-year mortgage rate is a rate, I'll click annotate, and then here, force original data format. So I want to view this one as a rate. And there it pops back. We recognize that 7.08% number. And we'll do the same thing for this refinance share, because it's also coming in as a percentage of those total number of originations. And now still doesn't look like what we saw in the slide, right? But I'm going to go to panel layout and panel per security, or panel per data point or indicator. So now we have everything broken out very nice and neat. If you really wanted to spruce this up even further, then we could change the colors here, so each of these stands out from the other. And boom, that's the chart that we were looking at as far as I can tell. And then if I switch this into presentation mode, now you see what we saw, and I can export that data behind the chart, or I can download the image or print it out on a PDF. Okay. Doug just asked a question for everyone still with us. Do you have any charts on the concept of the market bottoming before the economy bottoms, or ways to create that? Good pop quiz for us, Doug. And I think the best way to look at this, if I reset all, you tell us if this really answers your question, but I'll enter in like the S&P 500, that's my market piece. And then we can add something like, under our chart options, show US recessions. And if I take this over, maybe, this is going back to 1990. That's when our total return metric goes back to, but the S&P 500 itself would go back much further. So this could do the job for you, Doug, where you say, here's where the market, these grays are economic periods. And so zooming in on any of these timeframes to see how the market did and what the timing of that change was. Hope that does the job for you, but let's look at from 2000 to 2010, for example. And now we can kind of see, and maybe you want to look in as I hover over, you see up here my value and my date. So maybe this could help out with that talk track. Hope so. Okay, to close things out here. Thank you for joining, everyone. Just got to get to our conclusion slide. Here we go. Once again, we are sending this recording to everyone on the call. So if you'd like to get into the recording or the slides themselves, watch out for that email or head over to our YouTube page. And once again, thank you for joining. We hope you learned something, and we hope you found all these resources that we create and share for you valuable. Joe, thanks for your insights today.
Thank you, Connor. It was a pleasure as always.
All right. Thanks, everyone. Have a great rest of your Wednesday.